Welcome back to the channel, guys. I just want to do a quick video on fees within an ETP. So I've done a bit around the taxes and I done that whole video around the NAV erosion. And one of those boxes in there was around the fees having an impact on the fund. And I wanted to go into a bit more depth around the fees because it's really important that you keep more of what you earn. And fees is a really important part of that. And from a cost efficiency perspective, it can be up to 70% cheaper. So it's a really important factor. So I really want to dive into the impact of fees. I've also tried to make the text a little bit larger. I've had feedback around people watching this on their TVs and things like that, and things being a bit cramped and small and hard to read. I don't know whether this is going to be any better. I'm hoping it will be. Let me know in the comments at the end of this video whether it is better. And please make sure to subscribe as well. That's really important for me to know whether this content is actually helping you guys out there. So let's dive straight in then. What are you paying the actual fees for? So the total expense ratio, typically known as the TER, isn't a fee, it's a bundled cost for essential services. Unlike mutual funds, which typically have loads of hidden costs, ETPs packs everything into one transparent number. Majority of that is the management fee, about 65%. And then you've got some administration and custody fees, around 20%. And then index licensing, maybe 10% of it. And then the other is typically operational. Obviously, the management is them, in the case of income funds, are actually running the execution of the option strategy, which means you're not worrying about when to roll. You're not worrying about setting the strike price. They're giving all of that knowledge that they have and applying that on your behalf. There's also the custody, so the safekeeping of the assets, whether that be the cash or the underliers. And they also do the daily NAV calculations and present that back to us. So there's a fair amount that goes on in terms of running a fund, which is not always apparent. Now, not all of these funds are equal in terms of what they charge you. And so you've got these passive ETFs. So typically S&P 500 or an all-world fund, their fees will be typically low, very low in fact, typically around 0.1%. It could be even lower than this, right? We've seen them at 0.05% even. The idea here is they're very passive, they just follow an index and they're able to keep the fees pretty low. We then got these income ETPs from people like Income Shares, where they charge 0.35 to 0.55% for that management fee. Okay. Now, it is actively managed. However, they are keeping the fees fairly reasonable. I've seen fairly active funds be in the range of 1.5%. And we see this in the US, right? Some of the US funds are around 1%. And we'll go into the impact of why that can be quite bad in comparison to 0.55%. And then we have more kind of hedge funds, which can even get up to 2.5% in terms of their actual fees. If we were to look at this, starting off with, let's say, a 10K investment over a 20-year time horizon, we can actually see there's quite a drastic difference here. So after the sort of 20 years, you'd get 35K versus 29K. So the fees are a kind of almost a silent killer in a way. At 1% fee difference sounds small, but over 20 years, it destroys nearly 20% of your portfolio's wealth. So it's quite a substantial amount. The projected savings on that 10K is 6K. So it's quite a important move to look at the fees, in my opinion. In terms of the transaction, you've got the gross value, the assets at market close. You've then got a fee split, which is 1/365th of the TER is removed daily. And then you've got the net asset value, the official price that's published. Okay, so this is a daily impact on the fund. So from a final verdict perspective, there is still full transparency. There's no hidden loads. There's one simple TER. You've got access to strategies previously reserved for potentially hedge funds at a fraction of the cost now. But you've got to understand the compounding growth effect. Trying to keep the fees low is really important so that it doesn't become that silent eroder on your wealth over a period of time, or even your income over a period of time. So thanks to the 100% Club for getting to the end of this video as always. Hopefully you found this useful. Nothing, as always, constitutes as financial advice. It's all for entertainment purposes only, but hopefully, as I said, you found this useful. Let me know in the comments below whether you actually look at the fees of these funds. Is it something you pay attention to? Do you look at the management? Do you look at the total returns? And do you monitor the fees regularly and what funds you're actually invested in? It'll be useful to know in the comments below. As always, like and subscribe. I will catch you on the next one.